Hi, I'm Dong Sean. Welcome to Digging into China, where we explore China in depth to review unique perspectives. In mid-May, the U.S. Treasury's auction of 20-year bonds fell flat, with the winning yield exceeding 5%, stirring considerable market buzz. Chinese financial media seized the opportunity to gloat, proclaiming that U.S. dollar bonds were unwanted and America's credit was faltering. Yet, the irony struck swiftly. On May 23rd, China's Ministry of Finance issued its 50-year special treasury bonds, only to face a similarly lackluster response. The winning yield reaches 2.1%, well above the anticipated 2.025%, making the first notable rise in bond auction yields since 2022. This triggered a surge in yields across all long-term Chinese bonds that day. Having just mocked the US, China stumbled into its own embarrassment, a classic case of being humbled right after pointing fingers. This raises a pressing question. China's financial institutions are often said to follow the Communist Party's directives without hesitation. So why, when the Ministry of Finance issued these bonds, did major banks and insurance firms, the financial titans, collectively hold back? Shouldn't they have eagerly supported the auction, ensuring its success? Today's discussion will explore this issue, uncovering the deeper economic concerns this reveals. Let's begin by comparing two significant events in the global bond market: the U.S. Treasury's 20-year bond auction and China's Ministry of Finance's 50-year special treasury bond auction. Which performed worse? First, the U.S. On May 21st. The U.S. Treasury conducted its routine 20-year bond auction, issuing $16 billion. The winning yield was 5.047%, slightly above the expected 5.035%, a modest gap of 1.2 basis points. While the auction's outcome was underwhelming, this bond has never been a market darling. It was discontinued during the Obama administration and only reinstated under Trump. Thus, while the auction wasn't a triumph, it wasn't a disaster either. It's a niche instrument that typically attracts limited enthusiasm. By contrast, China's May 23rd auction of 50-year special treasury bonds was far more awkward. The ministry issued 25 ultra-long special treasury bonds Series 03, valued at 50 billion yuan. The winning yield hit 2.1%, a full 7.5 basis points above the expected 2.025%. Unlike the US's minor 1.2 basis point shortfall, this 7.5 basis point gap signaled the market's clear message: higher yields were required to entice buyers. Unlike the U.S. 20-year bond, China's 50-year bond is no minor player. This was the inaugural batch of ultra-long special treasury bonds, personally endorsed by Xi Jinping and imbued with significant political weight. The Ministry of Finance and the state media promoted it relentlessly, emphasizing fiscal precision, domestic demand growth, and restored confidence. Yet, the market responded with indifference. Confidence may not have been boosted, but the yields certainly were. The auction's bid-to-cover ratio was a mere 2.27, among the lowest in China's bond market history, barely enough to clear the sale. Financial institutions showed little deference to Xi's statutes. Worse, the auction's fallout dampened the sentiment across China's bond market, driving up long-term bond yields and pushing prices down, even for the typically robust 10-year bonds. So, which auction was the bigger misstep? The answer is clear. The US saw a tepid response to an already unpopular bond. China, however, faltered on a politically significant, heavily promoted project. In essence, the US experienced an expected stumble. China suffered a meticulously planned failure. If we apply the same critical lens Chinese state media used on the US bond market, China's auction might be headline: China's credit collapse, bond market fate, sandpaper offerings. The lackluster response to this ultra-long bond auction was indeed unusual. It left not only ordinary investors but also market institutions perplexed. To understand why, we must consider two critical factors. First, hasn't China's central bank recently lowered interest rates and reserve requirements? This should have injected ample liquidity into the market, easing conditions. In other words, the central bank provided a preemptive boost. Yet, when the Ministry of Finance presented these bonds, the market recoiled, effectively saying, "We are not buying it." This suggests liquidity is present, but confidence is absent. Second, China's financial institutions are predominantly state-owned. Shouldn't they align seamlessly with the party's directives? Historically, the pattern was straightforward. The ministry issues bonds, banks purchase them, and the deal is done. This time, however, the ministry prepared the stage only for institutions to respond with, "We hear you, but we are not participating." This isn't merely a slight to the ministry, it's a direct affront to Xi Jinping. These 50-year bonds were a flagship project backed by the party central committee, the state council, and the ministry, with Xi as its public face. Yet the market's response was as if it hadn't even tuned into the state broadcast. What explains this disconnect? The central bank provided liquidity, and these institutions are the party's own. Why was this bond sale so challenging? The issue isn't a sudden disloyalty within the financial system. Rather, deeper economic issues are eroding the party's ability to steer the market. First, the government is increasingly reliant on borrowing against future resources, and the market is growing wary. These are 50-year ultra-long bonds, meaning repayment is promised half a century from now. The market is questioning whether the party can endure that long. Unlike a democratic government, its stability isn't guaranteed. Who can predict a revolution or regime change? Moreover, issuing a 50-year bond signals fiscal strength, resembling perpetual debt. Is China planning to sustain itself through borrowing for decades like Japan? Bluntly put, the special in these bonds reflects fiscal distress, not economic strength. The market's interpretation is logical and justified. Second, the central bank's monetary easing is no longer reviving the economy, and the market recognizes this policy's limitations. China has implemented numerous targeted reserve cuts, structural tools like a PSL and the relending facilities, exhausting nearly every monetary level. Yet, the economy remains stagnant. Why? Businesses are reluctant to invest and consumers are hesitant to spend. Liquidity abounds, but the demand is absent. The ministry bond issuance appeared to capitalize on low rates, but it was essentially sneaking in financing to cover old debts. The market saw through it. This isn't about economic expansion, it's about borrowing to plug fiscal gaps, and doing so aggressively over a long time. The market's response: why should we take on your burden? Consider this analogy. A relative asks to borrow money during low-rate times, claiming it's for a business venture. You discover they are just paying off credit card debt, covering past losses, not building anything new. Would you lend? Likely not. The market is in your position, and the ministry is that unreliable relative. Third, why are financial institutions suddenly hesitant? It's not entirely surprising. They comply with the party, but only when it doesn't jeopardize their interests. Supporting a national policies or making symbolic gestures is one thing, but asking them to invest heavily in 50-year bonds and bear the losses, that's when caution sets in. The financial sector is struggling too. Banks face historically low net interest margins, stagnant loan growth, and dwindling deposits. Relying solely on interest spreads is barely sustainable. In this context, the ministry's 50-year bond with a mere 2% yield, long duration, high volatility, and a significant risk is a financial nightmare. While institutions voice support for party policies, their actions are more cautious. They will buy bonds if provided with hedging tools, relending quotas, or fiscal subsidies, or if the central bank directly funds the purchase. But expecting them to absorb the risk without assurance, they are not here to play the fool. In plain terms, without the clear guarantees, subsidies, backstops, or interest rate protections, institutions will express dissent subtly. They'll voice support but act cautiously, delaying or dodging where possible. Don't overestimate the party's top-down authority. When real money and risks are at stake, every department in this system is adept and sidestepping responsibility, passing the buck, delaying or feigning ignorance. Some may counter, you said the financial system isn't cooperating, yet they are fully engaged in resolving local government debt. Indeed, they are cooperative there, but only because the party provides explicit assurance. The Ministry of Finance has enabled refinancing, allowing local governments to issue new bonds to manage old debts, effectively delaying risks. The central bank supports this with relending tools, ensuring banks don't risk their own capital. It's a deal with a safety net. For these 50-year bonds, however, with low yields, long terms, and full risk exposure without support, their stance is clear. Sorry, I'm out. Don't assume state-owned bank executives are driven by ideology. They face performance metrics, profit targets, stock price pressures, and career risks. Poor financials or vanishing profits could cost them their positions. Who would jeopardize their livelihood? So abandon the notion that following the party explains everything. The financial system isn't defying the party, it's prioritizing survival. The lackluster 50-year bond auction wasn't a technical error or a fleeting market mood. It exposed a fracture in the system's facade. You thought the central bank's liquidity would inspire gratitude. The market saw a scheme to exploit it. You thought the party's own institutions would rally to the cause. They quietly stepped back, saying, "You first." You thought a politically symbolic bond backed by Xi Jinping would anchor the market. The market turned and walked away. The ministry aimed to sell bonds, but the market saw an empty promise, a reflection of fiscal unease and a test of the system's credibility. 50 years is a long horizon, but it comes down to this. If you can't secure the market's trust today, how can you convince anyone you will honor a debt 5 decades from now? Thank you so much for watching. If you find this video helpful, please like it, drop a comment below, and hit the subscribe button right here. It really helps YouTube suggest my video to others. I'll be back with more content soon. Until then, be well.